where we break down complex economic shifts shaping the world. Today's focus is on a crucial topic, the Indian Rupee hitting a record low against the US dollar. This isn't just a market blip, it's a reflection of complex global and domestic forces. Whether you're an economist, policy analyst, or simply interested in India's economic outlook, understanding the forces behind the rupee's slide is key. We'll unpack what's driving this depreciation, explore its impact, and dive into what policymakers and the RBI can do to stabilize the rupee. So, get comfortable, and let's dive into the big picture and the details that matter. On November 7, 2024, the Indian Rupee dropped to a historic low of 84.29 against the US dollar. This dip wasn't just sudden. It's the result of layered, complex economic factors. Here's a closer look. 1. The rising power of the dollar. The US dollar has surged, driven by global investors seeking stability amidst economic uncertainties. Following Donald Trump's 2024 presidential win, markets anticipate a policy environment favoring US growth through corporate tax cuts and deregulation. A stronger dollar often translates to weakness in other currencies, and the rupee is no exception. The US dollar remains the primary reserve currency globally, so its rise can create ripple effects, devaluing emerging market currencies like the rupee. 2. Foreign investor exodus. FII withdrawal. Foreign institutional investors, or FIIs, are reducing their exposure to Indian assets, reallocating capital to markets like China, which is currently perceived as a more attractive investment hub. Just in November 2024, FIIs sold over $1.5 billion in Indian equities, adding to a cumulative outflow of over $11 billion in recent months. This capital flight puts pressure on the rupee, as investors sell rupees to buy dollars, contributing to the currency's depreciation. 3. Global oil prices and geopolitical tensions. With ongoing geopolitical tensions, especially in the Middle East, OPEC Plus has delayed scaling up oil production, keeping oil prices high. Since India imports over 80% of its crude oil needs, this price surge adds to India's import bill, increasing demand for US dollars and exerting further downward pressure on the rupee. 4. Domestic economic strains. India faces significant internal challenges, including underwhelming corporate performance. In Q2 2024, around 2/3 of Nifty 50 companies missed earnings forecasts, prompting analysts to downgrade projections for FY 2025. With high equity valuations and underperformance in earnings, India's appeal to foreign investors diminishes, further weakening the rupee's standing. A depreciating rupee has profound implications. More expensive imports. A weaker rupee makes essential imports like crude oil, electronics, and machinery costlier, increasing input costs for businesses and impacting consumer prices. For an economy as import-reliant as India's, this effect constrains sectors dependent on foreign goods, from energy to technology. Rising inflation, higher import costs, often lead to inflation. A depreciating rupee fuels inflationary pressures by increasing the price of essential goods, eroding consumer purchasing power, and potentially dampening economic growth as households face higher living costs. Increased debt, service costs. India holds a significant amount of foreign-denominated debt. As the rupee falls, the cost to service this debt in dollar terms rises, squeezing the government's fiscal resources and complicating budget management for growth-oriented spending. Policy solutions. What the RBI and government can do to stabilize the rupee. To mitigate the rupee's volatility, a coordinated policy response is essential. 1. RBI's Forex intervention. The Reserve Bank of India has been intervening by selling dollars from its foreign exchange reserves to cushion the rupee. While this approach provides temporary relief, sustained interventions are limited by the size of India's Forex reserves. Additionally, excessive intervention can deplete reserves, leaving little buffer against prolonged economic shocks. 2. Attracting foreign direct investment. The government can play a pivotal role in enhancing India's investment appeal. By prioritizing ease of doing business, simplifying tax regulations, and investing in infrastructure, India can attract more foreign direct investment, stabilizing capital inflows and, consequently, the rupee. 3. Boosting exports. A robust export strategy can support the rupee by earning foreign currency and improving the balance of payments. Initiatives to promote sectors like IT, pharmaceuticals, textiles, and agriculture could help bolster India's export earnings, creating a buffer against currency depreciation. 4. Inflation control through monetary policy. To keep inflation in check, the RBI may need to consider raising interest rates. While higher rates can attract foreign investors to Indian assets, bolstering the rupee, it's a double-edged sword. Elevated rates might curb economic growth, so a balanced approach is essential. The road ahead. Future outlook for the Indian rupee. In the near term, the rupee's outlook remains uncertain. Global factors, such as the economic trajectory of the US, fluctuations in oil prices, and the Federal Reserve's interest rate policy, will continue to impact the rupee's value. India's monetary and fiscal policies will play a decisive role in steering the rupee towards stability. In summary, the rupee's depreciation is not just a statistic. It's a symptom of broader global and domestic challenges. By understanding these, policymakers can craft strategic solutions to guide the economy towards resilience. If you found this analysis insightful, be sure to like, subscribe, and hit the notification bell for more content that breaks down the complex world of economics. Let us know in the comments. What strategies do you think will be most effective in stabilizing the rupee?